Now the next journal is called cash book. Cash book is the fourth journal I want us to look at. We had looked at sales journal. We had looked at sales return journal. And then we had done purchases journal. As well as purchases return journal. Return journal. So these first four we had done them with illustration. So the next thing I want us to handle is cash books. Now, what is a cash book? That's the first thing to start with. A cash book is the only journal that records cash transaction. We had talked about the others. So the first four I've listed here do not record anything on cash, but cash is recorded in the cash books. We have got different types of cash books. Number one, what we call single column cash book. Single column cash book. Number two, double column or two column. Double column or two column cash book. Number three, what we call three column cash book. Four, what we call petty cash book. Petty cash book. So I want us to look at each of them. Remember this, that in the cash book we record what we call both capital and revenue receipts and payments. Revenue receipts and payment. That is, we could be receiving money. We could be spending money to acquire a non-current asset. We could be spending money to pay for an expense. Expenses, that is what we call revenue expenses, are those that are for one accounting period. Capital expenses are those that relate to a number of years. Like when we buy a motor vehicle, we shall use it for a number of years. Let's say 10 years, 5 years, 20 years. It is a capital in expenditure, what you abbreviate as CAPEX. But when it comes to expenses like wages and salaries, insurance, can have electricity, we could be paying for something like power, among others. Those ones are what? Revenue expenditure. So cash book records all of them, both capital receipts and payments and revenue receipts and payment. I remember talking about receipts and payment in our first topic, so I hope you still remember that. Now, I will start with the single cash book, single column cash book. Single column cash book is a cash book where the cash account will have cash account and the bank account separately maintained. They'll be on different what? On different pages or folios. So for single column cash book, we have a cash account and bank account on separate pages where anything paid on cash or received in cash is recorded in the cash account. Anything paid by check or received by check are recorded in the bank account. That's what we call single column cash book. We will not do any transaction on that. Let's go to the second type of cash book, what we call double column or two column cash book. Double column or two column. Double column or two column. Now, when drawing the cash book, I will draw a complete ledger with the 4 columns. We had what we call debt, details, folio, and then amount. You can as well do without folio. Column not a must because the cash book may be so stuffy, especially when talking of 3 column cash book. We can do without folio, but I will show it for 2 column cash book so that you get to understand what it looks like. So this is how it looks like. Now the name double or 2 refers to the amounts column. The amounts column will be 2. So we'll have debt, details, and have folio, or we can do without it. And then the first amount is for cash. And then we have bank. We have debt, details, folio, cash, and bank. These are the 2 columns. And then double line here. We start again. Debt, details, and have folio, and then cash, and then bank. So those are the 2 columns you're talking about, double column on either side. So this is the debit side, this is the credit side. I will do a question on this one so that you see what happens. Before I do a question, I want us to understand something called contra. A contra transaction is a transaction that occurs and is completed in the same book of account. What do I mean? In the case of cash books, we may have money being moved from the premise of the business to the bank in our account. We may also withdraw money from the bank to our cash till or our safe at the business. Those are the main contra entries. We are saying a contra entry is a transaction that occurs and is completed in the same book of account. Our book of account is cash book. We are saying we have a transaction that will take place, which, as we know, according to double entry rules, we normally have 2 accounts, one which is debited, the other one which is credited. Now, the debiting and crediting in this case of contra will take place in the same cash book. So examples of contra entry 1 is number 1, deposit or cash deposited. Cash deposited. Cash deposited. So when we deposit cash, first of all, this money has come from the cash till at the business or from the safe. So cash being an asset, and we are taking part of it to the bank, we are reducing the cash account. We are saying, since it's an asset, we shall credit what? We shall credit the cash account because cash is leaving or reducing, is going down. Being an asset, we credit. That money will be taken to our bank account at the bank. So our bank account will do what? We'll have it debited. So we'll debit bank. Where does this debiting take place? This debiting, we will do it in our cash book, not at the bank. What the bank does is right opposite of what we do at our business, in our business books of accounts. So we will do this in our books. This is not the work of the bank. On the side of the bank, they will be doing what we call crediting our bank account. Why are they crediting our bank account? I'm saying that this transaction, this recording, is what we do at our enterprise. Once we when we carry cash, we take to the bank. The moment we land back in our business with the deposit slip, you must do this entry. But at the bank, the moment they received money, they credited your account. Crediting your account means that it is a liability in the bank. We know when assets increase, we debit. And then why is the bank crediting our bank account? To the bank, in their books, that money they have received is not theirs. It is money belonging to a client who is us. So to the bank, the money we have given them is a liability. That's why you'll go to the bank and you're told you have a credit balance. It doesn't imply that you have no money. It means they have money they owe you from their statement, from their side. It's an owing to you. That's why they will reflect it as what? A credit balance. So that implies that they owe you money. To them, the money they hold on your behalf is a liability. We'll do that, more of that when you'll be doing bank reconciliations so that you get to understand it better. That is the first contra entry. The second contra entry is Cash drawn for office use. Cash drawn for office use. Now we can draw cash for personal use. That is, the owner of the business can draw cash for personal use. That one is accounted for as drawings. This one here, it is money from the bank account to take care of the business operations, not to go to anybody's pocket. We are saying we have got two accounts. We have bank and cash. Now, our bank account, we are taking money from it. So, in our books, when we take money from our bank account, we are saying we are reducing our bank account. So, our bank, being an asset, shall be credited. So, this is what? The drawing from the bank. So, when you take money from the bank, once you arrive at the premises, you as an accountant, reduce the amount that you expect to be in the bank account on their end. And then you are now bringing it to your business as cash. You are going to add your cash till. So our cash, being an asset, is increasing. We shall debit it. So we shall debit cash. Of course, there are what we call transaction costs. Transaction costs are called bank charges. We shall talk about them when we'll be doing bank reconciliation. Now, this is the first contra entry and the second contra entry. So we will be seeing them in questions featuring there, and that's how we shall account for them. So remember, with the withdrawal of money for personal use by the owner, it is not a contra entry. That is a drawing. We are getting money from the business to the owner of the business. Now, let's do a question that is found in our notes, which you'll get from the LMS and the notes attached. The question reads, the following transactions related to Utambuzi Company Limited for the month of October 2023. The first transaction is began business with 700,000 in cash and 3.5 at bank. Let me extend my cash books to accommodate these transactions. Fine. The amount that we begin business with is called capital. So we have two accounts affected. We have capital account and bank account. In this case, we are not drawing a capital account. We are only showing the cash book side. So in the capital is going to increase, therefore we shall credit it. But this being our asset and it's increasing also, we do what? We debit. So I'll label the year here. So we'll have got the year 2023. The month is October. So October, and then I'll be listing the days here. Again here, 2023, October. Then the days will fall on that column. So on first, the details is capital. So we shall debit cash. Capital, that is in cash, 700,000. At bank, 3.5 million. Then next, bought goods by cash amounting to 1,000. So we are only capturing everything on cash. If you ever meet anything on credit, we will not feature it here. We shall take it to the sales journals and purchase journals, but not here. So this is what? A purchase of goods. I said purchase of goods is called purchases. So goods amounting to 1,000. So we utilized money from our cash account. That's on 4th. So that's cash out. So cash is reducing. On 4th, I'll write here purchases. Purchases. The worth is 1,000. And then withdrew 200,000 for office use. That is the first contra entry we have. First of all, we go doing the drawing. The drawing is a reduction in the money we have at bank. Being an asset, we shall do that on the credit side. So I will first of all record the amount from where it's coming from. That is our bank account, 200,000. By starting with the amount, it makes it easier for you to do the right recording under details column. So it's leaving bank to where? To cash. So always do that to avoid confusion, to cash. So we have done the withdrawal. We work with the money to our entity or to our business on the very day, 5th. Record what? Here, money that is coming in is coming to our cash till. So I record the amount first. So we can't have cash, no. It's coming to cash from bank. Now, since it's a contra entry, we shall write capital C with those marks, also this side, to imply a contra entry. And then on 9th, we paid. Paying means what? Money is leaving. Leaving through which channel? By check, that is bank. So on 9th, we are paying something called insurance. Insurance, and the money being utilized is the one that is at the bank. That is 10,000. On 13th, sold goods. When we sell goods, we are going to receive money from the buyer. So money will come in through which channel? We are told sold goods to PKL amounting to 80,000, receiving payment by check. So on 13th, we are calling them sales. Sales, and their worth is 80 and came by check. So we record under bank column 80,000. Next, on 14th, paid 40,000 for repairs and maintenance by cash. So payment means money is leaving, and this being assets, we shall record on the credit side. But through which channel? We paid by cash. So on 14th, we are paying for repairs and maintenance, and we are paying that by cash. So cash account or cash column, we reduce it by 40,000. On 17th, we are receiving money from James Adeta by check. Receiving money means assets are increasing. Which asset? It is by check. So bank is going up. On the debit side, 17th, I'll write here James, and the money is coming in via check. That is 150,000. Next, on 20th, deposited 89,000. This deposit is not from any other source but from our cash at the business premise or at our office. So before depositing, we must get that money from our cash book. We must remove it from our cash till. So we shall show the money out from cash. Money out means what? We credit being an asset. There's a reduction in cash. So I'll write here what? I'll go first about the cash column. Reduce it by 89. Where is it going? It's going to the bank. So on the details column, I'll write here bank. Remember, it's a contra. Then on the very day, I go and put in the bank account what you're calling depositing. So bank, that is, the money is coming from cash to bank. So record first of all in the amounts column to avoid confusion. We can't have bank. Bank is entering the bank from which source? From cash. And since it's a contra, show that see there and record it accordingly. On 22nd, paid 23 to Equity Bank as installment on loan taken in 2022 by check. So we are paying. So money is leaving. Through which channel? From which source or from which account? It is leaving by check. So our bank account is reducing by 23,000 and it's going to pay what? Loan. I could write the Equity Bank or just loan repayment. Still, okay, loan repayment or just payment. Loan repayment. Loan repayment of 23,000 by check. So we've reduced our bank account balance. On 23rd, received 17,000 as dividend, an inflow of money through which channel? We received it by check. So on the debit side, on 23rd, we are receiving money from KCB Foundation as dividends. So it is dividend income. Dividend income which came via check of 17,000. So that's an inflow. And then on 24th, paid cash of laborers 25,000. I will call it wages. That's still okay. Wages. We are paying them 25 by cash. So our cash column has to be reduced by 25,000. Then paid 16 to county government for single business permit. That's on 29th. That's a cash outflow, and it was made by check. So we are paying for business permit. We are paying for a permit. So that permit payment was done via check. So we are paying for permit. That is 16,000. So cash that's bank column will reduce by 16. And lastly, all amounts at the end of the month was banked except 170. What are we talking about? The money we are referring to is the money in the cash in the cash till at our business. We are being told all money was banked, but the cash still remained with what? 170,000. So we first of all ask ourselves, how much is cash account having? The inflows were 700 and 200, making it 900,000. Then outflows so far from cash, we've got that's 41 plus 89 plus 25. We have had 155 that has been paid out. So far, we're having a net figure of 745 in the cash till. We are being told all the amount is supposed to be transferred to the bank, and the cash till should only remain with 170,000. So you take 745 minus 170, that is 575. This is the amount that is supposed to be shifted from our cash till to the bank account. The act of depositing cash amounts to a contra. So the first thing is we take the 575 from the cash till, and then we go and do the depositing. Taking it from cash till means we record that on the credit side on 30th. Which account are we reducing? Cash. We are reducing it by 575,000. Where is the money going? It's going to the bank. And this, since this is a contra, we put it. I will put there. See those marks. We have now taken it from the cash till. We walk to the bank and deposit that amount on very 30th again. That amount is supposed to enter the bank column. That is 575,000. How do we call it? We first of all are saying, where is it coming from? It is coming from cash till. So record here cash and show that it's a contra entry. So we've done the recording. Meaning, on the this is the month of October, ends on 31st. So we have what? Balance carried forward. So you've been told cash should have a balance carried forward of 170,000. Now let's confirm bank. Bank inflows were how many? We had 500 plus 80, this is 230, then plus 89, plus 17, plus 575, that is 4411. The total debits are 4411 for the month. The credits or the outflows, we have 210, that is 233, plus 16, this 249. So the difference, 4411 minus answer is 4162. That's what you're calling what? Balance carried forward from bank. That is 4162,000. That is balance carried forward. So how do we balance now? So this is the last transaction. So I'll put a line here. Totals for cash is now 900,000. I'll put 900,000 here. This one was 4411. Again, the same level. this side, do the same thing. That is 900,000. This is 4,411,000. So I draw a double line, do the footing. Now, on the first day of the next month, which is November 2023, still first. Here I'll have balance brought forward from last month. Balance brought forward of how much? Cash, we have now 170,000. Bank, we have 4,411,000. That's how we balance this cash book. So that is how we record a 2-column cash book. Now we got the next one, which we call 3-column cash book. 3-column cash book. Three-column cash book. Now, 3-column cash book has an additional column on either side, making them 3, called discount. Now, what is discount? Discount is an allowance or a reduction on the price of a commodity. There are 3 types of cash discount. First of all, there are 3 types of discounts that we are going to deal with. We have got discount. First one is called quantity discount. Quantity discount. Number 2, what you call trade discount. Number 3, what you call cash discount. Now, how different are they? We are saying this is a discount offered to people who buy in large quantities or in bulk. It's called quantity discount. Trade discount, on the other hand, is one granted for people buying goods so that they can go and trade in the same good. That is, they are buying them for resale to other people. So they are given a reduction to allow them to go and sell them at a margin and get some profit on it. So it's called trade discount. So it is given to those going to trade in the same commodity. And then cash discount has got 2 more components. Has got 2 what we call discount allowed and discount received. This is a discount offered to buyers to encourage them to pay promptly. So you only qualify for it if you are paid within a given duration of time. So if you don't pay within that time given, you lose that discount. So it's called discount allowed and discount received. So allowed is one a business offers. Received is the one that business receives. So we are saying this cash discount, whether allowed or received, we are saying reduces the price of the commodity. So if you are buying, you receive. So it's an income. So it's an income. So on purchases. So it's what? Discount on purchases. It's discount on purchases. This one here is what? Discount on sales. So when you sell, you allow yourself to lose some amount to the buyer. So to you it's a cost. It's what? An expense. These are the 2 discounts that will feature in the cash book, adding an extra column on either side. So we know when the expenses increase, they are debited. So it will appear on the debit side of the cash book. So incomes are recorded on are credited when they increase. So we shall have this column on the right hand side of the 3-column cash book. Now let me show you the format of the cash book, and then we try a question with those discounts. So I'll have 3-column cash book. I will ignore the folio column because of the amount of space required. So this is a 3-column cash book. We'll have date, details, or particulars. Then I'll ignore the folio column. Now the amounts start with discount. So you have discount, allowed, then cash, finally we'll have bank. Then double lines, go to again, date, details or particulars. The amounts begin, discount but received, discount, received, cash will follow, and then bank will be the last one. This is the format of our 3-column cash book. Column, 3-column cash book. So this is the debit side, the credit side. Get to know that. I have a question I want us to attempt. Also shall be featured in your notes on the LMS. The question reads, the following transactions were obtained from the financial records of DCP Enterprise for the month of January 2024. First of that month, so I'll write here the year 2024, January, also here 2024, January. We begin recording the days as dates. So on first began business with 800 at bank, which we are calling capital. So part of the capital was put in the bank account, which is 800, and in cash is 85. So 85 in the cash, then 800 was at the bank. On third, bought goods. We said anything called bought goods. When you hear goods, it's either purchase or sell. So here we are buying. So we buy what? What we buy is called purchases. And that will cost money to leave. So cash out. Cash is reducing. We record on the credit side. I'll write here purchases on third. And then how are we paying? We paid it by cash, 34,000. Next is received, 295, after deducting discount of 2.5 by check from KPMG. So that's on 9th. How much have we received? 295. So 295 has flown in, and that came in by check. And this amount is after a 2.5 discount had been deducted, meaning it is 97.5% of what ought to have been received. So the amount not received is the discount. So we are saying that 295 is what? 100%. What are we looking for? The discount, 2.5. Sorry, this is 97.5%. Because discount had been deducted. So how much is 2.5? So we take 2.5, multiply by 2.5 by 295, divided by 97.5, you get 7564. That's 295 by 2.5 divided by 97.5 by 1,000. 7564.1026. 1026. So record under discount The amount was what? It was received. So we are receiving 295 because we've given the discount. What we are given is a cost to us. It's a discount allowed. 7564.1026. Next is the purchase of equipment. On 11th, we had bought equipment by check worth 250,000, receiving 2% discount. The worth of the equipment is 250, so that's 100%. But we are given what? 2% as discount. So what are we supposed to record? We are recording what we paid. We paid 98% of that 250. So 0.98 of 250,000 is what we paid. So we paid 245,000. So from 250, the balance is what? Discount we received. That is 5,000. Next is on 14th. On 14th, withdrew 100,000 for office use. Withdrew 100,000 for office use. That is, took 100,000 from the bank to the business. So we first of all go to the bank and get that money from there. So bank account we shall reduce by 100,000. Where is it going to? It's going to the cash till or our safe at the business. So it's a contra entry. That's why I'm recording with a C there. On the debit side, I do the same, but that money is going to be kept in the cash till. So cash column, where is it coming from? It's coming from bank, and that's a contra entry. On 17th, paid 10,000 by cash for electricity. 17th, we've got electricity. How much? 10,000 was paid, and it was by cash. Next, on 20th, deposited 25,000. Deposited 25,000. Where is this money coming from? We must show where the money is coming from. It's coming from the cash till. Then we go and put in our bank account. That is what the statement implies. So we go and do that on the credit side on 20th. First of all, we get the money from the cash till at our business. We come to our cash till and take an amount of 25,000. Where is it going to? That money is going to the bank. So I record here bank and I show it's a contra entry. The very day that transaction should feature in the bank statement. That amount is entering our bank account, and is coming from the cash till. So cash 25,000. So that's how we record it. Next, on 22nd received, a receipt is an inflow of cash or bank money either via cash or via check. So shall be recorded on the debit side. On 22nd, received 45 from Hadija Adeta by check. So that's bank column 22nd. Can write here Hadija. The amount that came in by check was 45. So I'll record under bank column. On 25th, paid 20,000 by check to Ken Poly after deducting 3% discount. So we are paying out. That's on the credit side. And we are paying out via which mode? By check. That is, the 20K is after deducting 3%. So 20K is at 97%. So 97% is the 20,000. We want 3%, which is the discount. So the amount that we are paying out is 20,000 by check. We want to get that discount. So it is what? 3 by 20, which is 60, divided by 0.97. That is how we arrive at the discount. So 3 by 20,000 divided by 0.97, that is 61. 6,000, that's 6,185.567. So discount received is 6,185.567. Where are we paying that money to? We are paying that amount to Ken Poly, the supplier. On 28th, paid salaries. That's our cash out. Through which channel is the money leaving the business? Our salaries. It left by check. So bank column, I'll record 100,000. Next is on 30th, received a receipt. It's an inflow, an increase in asset. So which mode of receipt is by bank on 30th? That is interest, is interest, which is an income from investment. You see the interest of 4,000 by check, and that's how we record it. So having done that, we are supposed to balance this cash book. Then I'll also show you how to record the discounts. So in this case, we shall not balance the discount account, the discounts column, sorry. We shall take them to discount allowed and discounts received, and I will show you how to do the double entry. So I'm only balancing the cash and bank columns. Cash debit is 185,000. The credits or the outflows, that is minus 44, minus 25, 116. The end of this month is 31st January. That is balance carried forward. Under a cash column, it is 116,000. Then we go to bank column. We had 800 plus 295 plus 25 plus 49. The 2 is 49. We get 1169. We net off the credits. That is 345. Then this 2 minus 120. That is 704. 704. So I will draw this line here. Same level here. Is 185,000 for cash. 185,000 is here. So it's well balanced. 1169,000. 1169,000. We put them like this. So on the first day of the next month, which is February 1st, we'll have balance brought forward from the previous month. We had 116 from cash and 704 from bank. So having finished that, now I'll draw the discount allowed account and discount received account. Now, when it comes to reduction of an account or deducting anything from an account is done on the opposite side of where the amount lies. So I want to deduct or remove the discounts from cash book. The first one is discount allowed. That amount is on the debit side of the cash book. I want to shift it from here to discount allowed account, though I won't record it there. So to remove this from this account, I will credit what? The cash book. And then I will debit the discount allowed. So that is on the last day of the month. I can write as 31st January 2024. 31st January 2024. That is cash book. Then the amount is 7564.1026. This other one is on the credit side. To shift it, I will debit the cash book, credit the discount received. So on 31st January 2024, right here cash book, that is 11,185.567. Now remember, these accounts are found in the income statement, or they are featured in the income statement at the end of the financial period. So we must balance them, or we must close them. Closing them, we say they are what? Nominal accounts. We transfer their amount to. So if it were assuming it's the end of the period, the financial period ends at this point, we shall do what? We shall transfer, that is 31st January 2024, we shall have it as to income statement, that is 75 64 1026. So I've closed that account at the end of the year, if that's the end of the year. This other one, same thing, 31st January 2024, that is to income statement, an amount of 11,185.567. That's how I record, then I foot it. So that's how we record transaction in a 3-column cash book. The last cash book is what we call petty cash book. Now, the source document for the first 3 cash book, the single column, double column, 3-column, is what we call what? Cash receipts and cash, just a receipt basically. Could be for payment, you'll see this one, for receipts, and this one, for inflows and outflows. So it's what? A cash receipt. So let's now talk about the last kind of cash book, which you call petty cash book. What is a petty cash book? A petty cash book, from the word petty, a petty cash book is a cash book that is only used for expensing petty payments or petty expenses. Smaller expenditure that do not have to be done by the main cashier. Now, how does a company reach a point and decide we need to have a petty cash in place or a petty cashier to do the transaction? You may find that we have the main accountant. As the business continues to grow, the number of transactions shall be so enormous such that he or she cannot handle them alone. So what happens, the firm may have to hire a junior cashier or another junior accountant to help in expensing the very many minor payments that do not require long process for approval. Of course, for somebody to be given the money, they must fill a petty cash voucher, which must be approved very fast and the money expensed. So we are saying this petty cash is only for expensing money. The only inflow is what the junior cashier will get from the main cashier at the beginning of the period. So how do we maintain cash book? The petty cash book. The petty cash book is maintained on what we call impress system. An impress system. An impress system is a system where as a given amount is set that is supposed to be spent through the cash book, that the cashier cannot expense beyond. Let's say our petty cash limit is 200,000. That becomes our impressed amount. So in any given month, or could be a week, but most times it's a month, we cannot spend beyond 200 through petty cash. Maybe let me talk about some of the petty cash expenses. Could have something like stationery. Could have maybe transport. Could have wages or casual laborer wages, which don't have to wait until end of the month to be paid through the payroll. We can have something like, we can also have some suppliers being paid via the petty cash, those who are supplying small amounts of small value items or goods to the enterprise. They can be paid through the imprest. So these are some of the common expenditure that go through the petty cash. So we are talking about the imprest system. The imprest system requires that we have a set amount or limit that can be spent through the petty cash book. So when the petty cashier receives this amount at the beginning of the period, he or she will begin spending up to the end of the month. Let's assume This month, the petty cashier expended 160,000, meaning he has 40,000 remaining at the end of the period or the month. He will carry the petty cash book, which shows how much was spent, of course, with the petty cash vouchers attached as documentary evidences that there was outflow, with the signatures of who authorized those monies to be given out. So he will take the main cashier who will do an analysis and check everything before giving more money to the junior cashier. Now, after approving that everything was done correctly, the petty cashier has to be given an amount equivalent to the interest amount. That is equivalent to what he spent the previous period. In this case, he has 40,000. He requires an equivalent of what he spent last time, which is 160,000. The act of being given the amount that he earlier spent is called reimbursement. Reimbursement. One of the systems that run on, one of the services, like in Kenya, that run on Impress system is the M-Pesa services. The amount that is equivalent to the Impress amount, what they call the float. So the float is equivalent to how much they can give out to clients doing withdrawals. And when the money goes to zero, they have to go back and refill their float or get a reimbursement. Most of them do it through banks. They get reimbursement and begin again spending that amount. So that's how the M-Pesa system was developed. It was developed on Impress system. Now, let's now look at the structure or the format of the petty cash. This petty cash used to be called analysis cash book sometimes back, but the same thing. The reason why in some curriculum it's been called analysis cash book is because of columns where we have analysis of what is going to be spent. Let me show you that. So we have it this way. You've got the first column being receipts. Receipts will appear this side. Then we'll have date. It looks very funny, so you should get used to this format. And then we'll have details here. After details, we'll have what? We'll have the payments. Of the payments. So these receipts corresponds to debit. This corresponds to credit. It's like the credit side of the petty cash. And then we'll have this side split. We shall split this one into two. We have what we call analysis column. This is where the name analysis cash book came from. Analysis column. So let's assume we have got wages, we have got stationery, we've got postage and stamps and such like things. Being the expenditure allowed to go through petty cash, we'll have them listed in these columns. With a ledger column shall record an amount paid to any of the creditors through the petty cash. Now, I have a question I want to use to illustrate this. So, on this part of receipts, we'll have what we call opening balance brought forward. Then, we'll have what we call reimbursement, top up. This is the top up to the balance brought forward to have what we call what? What we call interest amount before we begin spending. Let's check the question we have. It will also feature in your notes on the LMS. The question reads, Diwa Sugar Company Limited, or can also have some other thing which I did not feature here. The PVC number, that's petty cash voucher numbers, can also feature there. for auditing purposes, we could have them featuring there. But I'll do without it in this case, but you can feature it somewhere so that all payments are what? Backed up by a voucher. You must have a voucher showing who was given the amount, who authorized it, and so on and so forth. So, Ndiva Sugar Company maintains a petty cash in its ledger account. The interest amount is 70,000. That's the maximum amount to spend through petty cash is 70,000. The following expense were incurred during the month of June 2024. First, the petty cash at hand, that is the opening balance, was 25,000. So I'll write here the date. It was June 2024. Right, 2024 June, the first day, I'll record the amount here. Then reimbursement will also take place on the very day. So day one, let me orient this one. So the first day will have balance brought forward, that is 25,000, after which we'll have reimbursement, that is restoration of the interest amount to 70. Now that we have 25, we require 45 for us to get back to our interest amount of 70. So we've been reimbursed, and the reimbursement took place on 2nd as per the question. Then expenditures begin flowing. Now, when showing expenditures, I will show the type of expenditure, the name of the expenditure, the payment, then I'll go and list it where it falls. According to the question, we are supposed to classify or to categorize expenses in the following categories. You've got postage and stationery, so I'll write here postage, the first one. Second one, cleaning expenses. Third one, motor vehicle expense, so MV expense. We've got wages, and then the ledger. Ledger is where we record the amount that has been paid to any creditor, any supplier on credit. So on next day, on 4th, bought full scaps. Bought full scaps. Full scaps worth 2,000. Let me list all of them, then we'll go and feature them where they're supposed to appear. 7th, paid wages. And the amount is 5,000. 9th, paid 15 for emails on 9th. Emails, 15,000. Next, on 11th, bought cleaning detergents. Bought cleaning detergents amounting to 3,500. And then 15th, paid Otieno, a creditor, 25, that is 20,000. So this is the person I was talking about, one of the suppliers, who the firm has decided that should be paid through the interest. We are paying him 20,000. Then paid fuel on 20th. Paid for fuel, 7,000. And then 24th, purchase envelopes. On 24th, purchased envelopes worth 8,000. That is stationery. And then paid 25 for cleaning. 2,500. Lastly, motor vehicle expense, 4,000. 30th. MV expense, 4,000. So having done that, we are supposed to record them in the correct column. So full scaps, those are for what? Postage and stationery, so it will come here, 2,000. I didn't write the full name, this is postage and stationery, so it falls there. Wages, we have a wages column here, that is 5,000. Emails, that's what? Now, the value of emails, emails will go to postage and stationery. So that's for post. Emails are like letters or electronic mails. So we'll have it recorded in this column. And then detergents are for cleaning, so we record under cleaning column. We had Otieno, a creditor, who is being paid through petty cash. So we record this amount in this column, 20,000. And then we have fuel. Fuel is for motor vehicle, that is 7,000. We have envelopes. Envelopes, that's for postage. Cleaning. 25,000, that is cleaning. Then lastly, motor vehicle expense, that's motor vehicle column. So let's see. We do the totals for each. This is 20,000. This is 5,000. This is 11,000. This is 6,000. That is 25,000. So 25 plus 17 plus 25, that is 67,000 is all the expenses for this period. 67,000, I'll record it here. So you can add them column of this row here. So 67,000 is how much you spent out of the 70,000. So we want to balance our petty cash book. I told you this is same as debit side. This is the credit side because it's cash we are dealing with. So outflows is 67, inflows is 70. So we're having a difference of 3,000. The debit side is more than the credit. So balance carried forward on the last day of the month, June ends on 30th. Balance carried forward is 3,000. So now the two are the same, 70,000. This side is 70,000. So we put it on that point. The question also requires that we show the reimbursement on the first day of next period. So we will go to the next month, which is July 2024. July 1st. Call it balance brought forward. We record on the debit side, which is 3,000. Now, amount restored to the interest is how much had been spent the previous period, which is 67,000, because we want our interest to be at 70. So this 3,000 plus 67,000 as reimbursement or restoration to interest. That's the amount that restores the interest, called reimbursement. So that is the end of the petty cash book. That's how it's supposed to be done. Now, the last journal I talked about was the general journal. General journal. What is it? Now, we've seen the first four, which were recording goods on credits. We had sales, sales return, purchases, purchase return journal. Those first four were recording sales and purchase of goods on credit, only goods. Now, the cash books are recording only cash transaction, both of capital and revenue nature. Now, we have what you call general journal. General journal. What about it? This one cannot record purchase of goods. If it's goods, First of all, it does not record the cash transactions. So it cannot, the cash transactions will go to cash book. Those that can't go to cash books will come here. And which one? You've got capital and revenue. Now, revenue expenditure of goods will go to the other four, which are what? Which are sales, purchases, return in and out. But if we have got purchase of an asset on credit, those ones will not go to purchase journal, because purchases account or journal is used to record purchase of goods, or what you call the trading stock. So we will not take it there. So such kind of transaction will come to general journal. So what are some of the transactions that go through general journal? One, what we call purchase of non-current assets on credit. We can have an asset bought partly on cash, partly on credit. The credit amount will come to a general journal. Then we'll have what we call share issue transactions. Share issue transactions, though they're no longer in our syllabus. We've got what we call error correction, can also be used in error correction. We shall do it as one of the topics in correcting errors among other transactions. So these are the common transactions that we record in what? In the general journal. I have some questions to illustrate that. I have a question I had done that will help us to see how general journal looks like and how we record it. Let me show you the structure. Then I do the question that I have, which also shall feature in your notes. So, general journal looks like this. So I'll draw a big one because I want to use it also for doing some questions. We'll have the dates. We'll have the details. After that, we'll have the debits and the column for credit. So this space is for the narrations on the transaction. So I'll draw a big one. We'll have the debit and the credit. No need of the folio, just these columns are important. Don't feature folio here. Now, I have some questions to use for this. The following transactions were obtained from the financial books of Calypso Limited for the financial year ending 31st July 2025. The first one, bought machinery from Dilbo Traders at 2.5 million on credit. Second one was on 6th, issued 200 ordinary shares at 125 shillings each. Third one, bought furniture 2.8, paying 2 million by cash, and the balance to be settled at a later date. Lastly, 27th, purchased equipment for 800,000 by check, which was recorded in the purchases account. That's an error. So I'll correct that error. We said when you purchase an equipment or an asset, we don't call it purchases. We call it what? An acquisition. So we record in the asset account against the mode of settlement. If it's cash or via check, we will credit that mode of settlement. So I will show the dates here. The first one is on 1st July 2025. Bought machinery from Dilbo Traders. So I will debit. We have got two accounts. One is the asset increasing, we shall debit it. And then the person giving us is Dilbo, and we are not paying him now. We'll pay him later. So we'll debit machinery, credit, Dilbo Traders. The amount is 2.5 million. 2.5 M. I will narrate here by saying we must show narration to record an acquisition of machinery on credit. We draw a line like that, sorry. That's the first transaction. Second one was on 6th, very month, 25. Issued 200 shares at 125. So each. So you have got 200,000 shares. So 200 by 125. 200,000 by 125. That is 25 million is what was being expected. So we have what? We've got money coming in. And I will not record cash here. We're assuming we are issuing shares today, and people are supposed to apply for the shares. So that amount is supposed to come in from applications of prospective shareholders. So we can recognize what? Ordinary share capital, because it's equity increasing, that is 25 million, credit 1. If cash was received, we'll debit cash. If it's yet to be received, we could show it as what? As application. If we normally have different or what we call installment issue of shares, where part of the money is paid at application, part of the money at allotment, and then we have calls. So if the money will be paid in installments, I will just recognize what? I will just recognize it as application money, or if it's coming via cash, I'll record what? I'll record the mode of inflow. So it could be coming right now, or should be coming later. So if people are supposed to apply for this money and pay for it once, I will record what? I could record it as application, 25 million. And if the money is coming in by cash, then I would record 25. But if now the cash is coming in, we'll show it in the cash book. So we are assuming the money shall be paid on application once. So at this point, we are not having any money coming in. I'll record that as application money. And that's also to record what? To record issue of shares at 125. Could be any currency, could be dollars, shillings, pounds, whatever it is. The next transaction, number 4, we had bought furniture 2.8, but we paid 2 million. So I only want to record the transaction that is on credit. For now, I would debit what? I would debit furniture. I will credit who? The person who sold us. I'll call them creditors. For now, creditors. Paid to M. The balance is 800,000. So to record acquisition of or balance on, record balance on furniture acquisition. Lastly, we bought equipment on 27th, but that was recorded in purchases account. So we go and undo what was done in purchase account. When we bought and recorded in purchases, what happened? We debited purchases, credited what? Bank or cash. So bank or cash was correctly recorded, but the error is in what? Purchases account. We want to remove that value from that account. I said, when removing an amount from an account, we remove from the opposite side of where the amount is. The amount is on the debit side of purchase account. How do I remove? I'll credit it. Where am I taking it? We are purchasing what? Equipment. So I will debit equipment with an amount I removed from the credit side of purchases account. And the worth was 800,000 also. We debit, we credit. So you can write there, to record what? To record correction of equipment purchase, recorded where? In purchases account. Recorded in purchases account. So we are correcting that error, just moving the amount from the wrong account to the correct account. So that is the last journal we are supposed to learn on this topic number 2. The last part of this topic is what we call the trial balance. Trial balance, and I want to break it down very fast. Trial balance. This is the core of understanding preparation of financial statements. Now, what's a trial balance? A trial balance is, I could define it as a summary of all balances from different ledger accounts that have been balanced at the end of the period. So a firm may have different types of accounts or ledgers of assets, capital, liability, incomes, revenue, expenses. We also have provisions accounts. At the end of the period, the balances from those accounts are brought in the trial balance. How does the trial balance look like? A trial balance, I've said, what? It's a summary or a columnar statement showing all ledgers of the firm and their corresponding balances at the end of the period. So we'll have the elements or the account here, the individual accounts listed and the amounts at the end of the period. I taught you how to balance accounts. So the figures you get from those accounts are brought here. I have a sample I want us to go through. Then I explain it in details. First one is land. Not very big. Or I can do a smaller one than this. You've got land. You've got purchases. So land is 200,000. Purchases 17,000. Provision for bad debts. First January 2025. That is 400. You've got sales 58,000. You've got bad debts 800. Inventory 1st January 2025 is 12,000. Buildings you have it at 75,000. And then you have what you call accumulated depreciation. Accumulated depreciation for buildings as 15,000. And then the next asset is motor vehicle, that's MV. The balance at end of the period is 65,500. Accumulated depreciation on it is 10,400. Next, we go to the others. There are so many. I will list the much we can use to study, but I want us to understand. Insurance, 4,800. We've got salaries, 6,800. Discount received, have it as 750. Selling and distribution expense. Selling and distribution, have it as 1480. It's an expense. And then we have loan interest, lighting, loan interest. You've got lighting. You've got 10% loan. For loan interest, 9,000. Next, 63. That is lighting, 6,300. The loan is 90,000. Then ordinary share capital, is 208. Next we have share premium, is 7,000. Then next we have 11% preference shares, with 5,600. Hope they'll fit here so that we can use all of them. Receivables, what we call debtors, trade receivables, 4,200. Payables, which are creditors, we have them at 6,700. And then current tax, 2,300. Then you have electricity. As 1270. The total is 4,150 for each. Now, looking at our trial balance, that has so many items, there are things I want us to understand from the list we have here. So, on the debit side of the trial balance, we have the following. So, debit, we have got assets, expenses. Assets, expenses. I didn't put something on returns, but I'll also show you. Assets and expenses are found where? Have what? Debit balances. So if you look at land, so on expenses, I also put there what? Let me also have what we call cost of sales figure, which is basically the purchases. So assets, expenses, purchases will have their figures in the debit column. We have land here, we have purchases, bad debt expense, inventory. I'll talk about it later. So there's an asset, buildings, an asset, motor vehicle asset, insurance expense, salaries expense, discount allowed. This is salaries, discount receipts and income. You've got selling and distribution expense, loan interest and expense. So on the debit column we have what? Assets. On the credit we have the following: revenue, stroke sales. We've got incomes. We've got capital, or what we call equity, shareholders' funds. We've got liabilities, both short-term and long-term. On top of that, we have what we call provisions. Provisions are found there. So like you have sales, credit, income. So an example of income, you have discount received. It's one of them. as an income. Liabilities, we have loan, credit. Provisions. Accumulated depreciation is also called what? Provision for depreciation. They have got what? Credit balances. So get to understand that. Now, there's something I've not captured, but it's also to appear here. What we call returns. We have return on goods sold, return on sales. So these are goods we took out, now they are being brought in. It's called what? Return inwards. Return on purchases. We bought by bringing the goods in. We are taking them back out. Return out. So return in will always, the returns will appear on the opposite side of the corresponding account. So sales have credit balances like this one. The return for sales will always appear in the debit column. Purchases appear on the debit like this one. If you see a return here with a credit balance, know that that's what? A return out. So if you're given a question and you only have one item called returns with amounts on the debit and credit, you should know that sales are on credit, its return should be on the debit. Purchases are on the debit, its return should be on the credit. Now, we have got what we call cash expenses and non-cash expenses. Cash expenses on the trial balance are those that have been paid. Cash expenses on the trial balance are those that have been paid. Example is what we call insurance, salaries. We have got selling and distribution, loan interest. Any cash expense, that is, any expense we have made in the cash book where money is paid out on and is appearing here, just know that that amount you are seeing here has been paid. Any non-cash expense like bad debts on the trial balance, it does not imply that it's been paid. Bad debts are debts which we're expecting to receive money on, but from the look of things, we cannot get any money coming. We choose to write them off. So no cash has been what? Spent. We've not lost, we've not given out any cash. We cannot trace bad debts on the cash book or on bank statement. So it qualifies to be called what? To be called a non-cash. Also, provision for bad debts. Provision for bad debts also, I will talk about provisions later. So I was saying, any non-cash expense like bad debt, amortization, depreciation, if you see them appearing here, you'll find them with debit balances. I mean for the year. Bad debts for the year. Depreciation for the year. If you find them here, it means they have been deducted from the corresponding asset account. Bad debts were on receivables, on accounts receivables, this one here. So if you see this 800, just know that these receivables, which are 4,200, were initially 5,000. 800 have been written off. So the bad debt on the trial balance are those already deducted from the accounts receivables. So the accounts receivables are already net of 800. That is, we are sure, or we are going to work harder to recover the 42, but the 800, there's no likelihood of recovery. That's why we've done what? Written it off. We have got provisions. Provisions, it was for motor vehicle, that value there. An example of provision is provision for depreciation, also known as accumulated depreciation. The provisions you see here refers to an amount already deducted from the corresponding assets. So you are seeing here building having 75,000 and its provision for depreciation being 15, and always this provision will be named or attached the first day of the financial year. You'll find them with the first day. It was 1st January 2025. You'll find them with the attached to the first day of the financial year. It implies this is prior year's depreciation. This is already loss assumed to have been already incurred on the assets. What we assume has already been lost on the So 15,000 on buildings has already been lost. So the net book value is the difference, which is 60,000. On motor vehicle, for the past years, already 10,400 has been lost. We are remaining with how much? That is 55,100. So any provision for depreciation you see on the trial balance refers to provision for depreciation for the prior years. If at any point, which is very rare, you find depreciation for the year, that is now a new provision, a new deduction on the asset value for the current year. That is a non-cash expense for the year, but we will not be finding it here. We'll be finding it in the additional information where we will compute. But in some cases, you may find it already done and put in the trial balance. Now, inventory on the trial balance. Inventory on the trial balance is always for last year, the closing value for last year. It is always the opening balance of inventory. Normally, it is dated the first day of the current year. Like this year begins January 2025 to December. So you'll find it with these dates. If not, always just know inventory featuring on the trial balance is the opening balance. The other thing on provisions which I had left out is provision for bad debts. This is what? This is provision for bad debts for the prior years or for the prior year. So this is already a provision that was made in the last year. I will talk about it more when I'll be doing sole trader and other accounts as we move on. So that is basically what we need to understand on the trial balance. Now, we have got some expenses that will be featured in the additional information. So after I teach you topic number 3 on what we call accrual concept, I will tell you how to adjust for those expenses and any other incomes that are listed off the trial balance. Maybe to wrap up this part, let me talk about expense paid. Expenses paid later. We are coming to the end of the year and you've done the trial balance. This is what you've gotten. And our totals were 150. 404, 150 for each. So end of the year has come. And then an expense is made, though I did not feature cash. We'll have cash here. Could even feature it anywhere. If we have an expense paid later, know that the cash account we have on the trial balance has not been deducted that payment. So I'll also show you that one when I'll be doing accounts for trader. I'll illustrate using questions on expenses that have been paid later and they've not been featured or captured. So I'll show you how to capture them and how they affect the figure of cash appearing on the trial balance. So that is the end of this part, but still I'll be referring to it more as I'll be doing other parts of the course. The last thing that is conjoined to this is the accounting, the financial statement. Sorry. If I may go back to where I began, when I began this topic, I talked about the accounting system or the accounting cycle. Let me go back to it so that we can remind ourselves what we said. We said we normally have what you call opening balances. Opening balances. From there, we'll have what? Transactions taking place where we'll have such documents emerging. From such documents, I said, we will get that information and record them on journals. I've looked at all the journals, from sales journal, return inwards, purchases, return outwards, cash, general journal. We've talked about all those journals. From journals, we talked about what? Posting. Posting to what? To individual ledger accounts. So we had posting taking place, posting to individual ledgers, After posting those individual ledgers, we did what we call what? Balancing of the accounts. We did the balancing of the accounts. After balancing them, we now get what we call what? The trial balance. We have just been. We'll have the trial balance. So trial balance followed. And then trial balance is supposed to help us do financial statements, but we may have some additional information, things that have been discovered which had not been captured in the ledgers. So you are posting the ledgers here. So any other adjustments must be made before we do what? Financial statements, what we call end year adjustments. End year adjustments. Then I told you the last thing, the end product is what? Financial statements. And I listed all the financial statements initially. So this is what we've been doing from the beginning. This one I told you is from the last year's periods, but we've done this. I did the posting, I balanced. You've seen the trial balance. And the adjustments, what will be following. I'll show you how we do them as we do this. So trade a topic, then I begin doing the statements. So what are the statements? We said there are 5 basic financial statements. We listed them in topic number 1. One was income statement or profit and loss. Number 2, we talked about statement of financial position or the balance sheet. Number 3, of course, which comes as the number 2 after income statement, what we call statement of changes in equity. Statement of changes in equity. Then number 4, we talked about statement of cash flow. Lastly, we have what we call what? Note to the accounts. So we talked about this in topic 1 earlier. So we'll be dealing with them in details in topic number 5 when we begin doing sole trader. So next we'll be doing topic number 3 on something to do with accounting standards and regulations in accounting. So that's the end of our topic number 2, though very lengthy, but now we've come to the end. So until next time, you keep going through the literature and the videos so that we can interact more on our platform. Thank you.
If you enjoyed this video, please like, subscribe, comment, and don't forget to hit the notification bell so you never miss an update.